morning. It's another wicked early Wednesday. The markets are searching for direction this morning, which is, believe it or not, par for the course. The usual suspects, of course, are talking about supply chain concerns, inflation, the Fed, China, absolutely none of which have anything to do with the short-term sell-off we experienced. There's a perfectly good and super simple explanation. Savvy investors and traders, of course, would be wise to pay attention because knowing how the game is played can give you a huge advantage. Here's my playbook. Point number one, why markets really dropped after great earnings. We all love a good story, which is exactly why the mainstream media is doing its best to explain the situation by attributing the sell-off to supply chain concerns, China, Russia, inflation, the Fed, and all sorts of other things. But you know what? None of those things has anything to do with the short-term selling pressure. Here's what's really happening. Big tech, Apple and Microsoft specifically, are two of the biggest, most widely held and liquid stocks in the world. When they move, the broader markets move. Simple as that. Highly leveraged traders are simply following a pattern they've set for the past few quarters. A, run the stock up into fabulous earnings. 2, sell just ahead of the announcement to avoid event risk. And 3, buy more to do it all again when panicked retail stock investors sell right into their hands over the next few days. If you're an investor with a longer-term perspective, use this to your advantage. If you're a trader, understand the fade. Both can be tremendously profitable plays. Watch my take with the fantastic Dagan McDowell on Fox Business Network earlier this morning on my channel. And on a related note, if you're interested, I hope you took advantage of the fade because I specifically mentioned it in yesterday's Morning 5 with Fitz. Tesla, Apple, and Microsoft are all great examples of what's happening. Point number 2, growing at early stage startup rates. People tell me frequently that they won't buy big tech because it's too big or too expensive. Good luck with that. I've heard similar arguments for many, many years. While I respect folks that have that opinion tremendously, the only thing many of them have gotten right is to be so wrong for so long, so consistently. Apple and Microsoft are growing at early stage startup rates, even though they are already among the most valuable companies on the planet. Assuming they won't get any bigger and more valuable is just because they already are is one of the most expensive mistakes any investor can potentially make. Take Microsoft's cloud business, for example. It grew at 51% in the last quarter alone. It's your move. You know what to do. Point 3, 2 more big bling worthy earnings reports. Now, it's no secret, I love earnings, especially when they come from big, well-known names that I own and recommend. This morning, for example, Pfizer reported a double, beating on both the top and the bottom line. So did McDonald's, which also beat top and bottom line estimates. Now, I'm tempted to make a pun about 2 all-beef patties, but that'd make me hungry, so I will not do that this early in the morning. Oh, and talking about other great companies, Pfizer, this just in. I told you months ago that COVID-19 could add $35 billion to Pfizer's top line, and people looked at me incredulously, much as they would a three-headed Martian. I'm used to that. But I said the same thing for booster shots and additional emergency authorization. Well, guess what? Pfizer management just updated vaccine guidance to $33.5 billion, and that's probably conservative too. To put this into context, J&J's full-year COVID sales estimate is $2.5 billion, Moderna's is $19.2, so roughly half. Anyway, repeat after me as many times as you need to. Best not rest. I own McDonald's and Pfizer and accumulating shares every chance I get, especially if the markets want to hand them to me on the cheap. Point number 4, this SPAC just got carried out feet first. It's yet another cautionary tale for anybody interested in SPACs. ATI Physical Therapy just reported their first earnings, and it seems to me that they may need some of their own therapy. The stock is down 54% in a matter of just 2 days following an earnings report in which management did not include a share count, a balance sheet, cash flow statement, and in which they lowered their already ridiculous guidance with EBITDA slashed 54%. The trend of complete deal slash guidance is happening with comical frequency, and it just goes to show you how greedy the companies underwriting these deals are. Do yourself a favor. Steer clear of SPACs, or at least take your money to Las Vegas while you enjoy losing it. Ouch. Point number 5, cryptocurrency has a bro problem. This article caught my attention because the crypto trading community has long been dominated by men, which is exactly why I believe women are going to change the landscape. Trading and investing is a lot like that. It doesn't matter whether you're talking about big versus small traders, institutions versus retail investors, dark pools versus lit markets. Anytime there's perceived to be a dominant group, one thing rings true above all else. People taking the opposite side of the trade frequently change the rules. Today's bottom line: when nobody is making money, it's because everybody has missed something. Figure that out and you've got a winning investment on your hands. I'd like to help. You got this, I promise. Make it a great day. I'll see you next time. Thank you for watching today's Morning 5 with Fitz. Click subscribe to get daily market notes right here on YouTube, or sign up for the email versions at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and more.